Okay, so welcome again. In this case, I have the honor of introducing you TAVI Costa. TAVI is the portfolio manager at Crescat Capital, and he has been with the firm for 6 years. TAVI built Crescat's macro model that identifies the current stage of the US economy cycle through a combination of 16 factors. His research has been featured in financial publications such as Bloomberg, the Wall Street Journal, CNN, Financial Post, The Globe and Mail, Real Vision, Reuters. TAVI is a native of Sao Paulo, Brazil, and he's fluent in Portuguese, Spanish, and English. Before joining Crescat, he worked with the underwriting of financial products and in international businesses at Braservice, a large logistics company in Brazil. TAVI graduated cum laude from Lindenwood University in San Luis with a BA degree in business administration with an emphasis in finance and a minor in Spanish. Hi, TAVI, how's it going? Everything okay there?
Muy bien. ¿Cómo estamos?
Estupendo. Fantastic, man.
All right. Ready to go here. Look forward to this presentation, and thanks for inviting me. I think this is gonna be a good one.
Well, I think it's this is a thing that I wanna share with our audience. In my case, I'm super glad having you on here because you are one of the greatest investors that is following the macro trends, and it's super interesting your job regarding this quantitative approach to identify the cycles in macro and precious metals. I mean, these ideas that you are talking about all the time about the current situation in the market that is super crazy and super interesting, and I think we are learning a lot. So I'm super glad of having you on and having the chance of sharing with our audience your thoughts. So we are ready to pick your brain, so you can go ahead if you want. And
all right.
We will be listening here.
Let me get here my prezo sharing. Can you guys see my presentation?
Absolutely, we can see it.
All right. So I'm going to start with perhaps a little bit of a long-standing imbalances that I see in the markets today, and then walk you back to where I see the opportunity in the precious metal space, which we've been talking about for some time now. And that is mostly a sector or industry, whatever you want to call it, that is being massively out of favor in our view, and how we would like to tackle this whole thesis. So if you just look at national debt, U.S. national debt versus GDP, you can see this. It's actually 3.5 times the growth in normalized terms, as you can see, versus debt and nominal GDP. It's pretty interesting how since the golden standard back in 1971, we've lost completely the discipline, especially fiscal, monetary, and financial discipline from governments in general. And we've been building a lot more debt to grow less nominal dollars of GDP. And it's a very interesting thesis, something that has been happening for a while, but more recently with the coronavirus and the pandemic, certainly this has exacerbated this problem. There is an issue that I see with especially the overvaluation of assets overall. And because of this lack of discipline from governments, what we saw was a growth of money supply and also a growth of monetary base by central banks, especially that have been doing that to hopefully boost financial markets in a way. And we can see here very clearly that in this ratio of S&P 500 to money supply, even with all this money that we've printed so far, equity markets are still historically overvalued. It just touched that same level that we did back in the tech bubble. And I think it's one of the most overvalued equity markets we've seen in history. It goes back to our thesis why investors would probably be going away from that and putting more money. So we're going to be inflows of money going towards the precious metal space. Another way of looking at this is just looking at U.S. household wealth relative to GDP. Well, that includes a lot of other things. You can see all the assets of the top first percentile, the bottom fifth percentile. What's interesting here is about 30% of the wealth in the U.S. households is actually coming from the top first percentile, which is the largest amount ever. Most of that, when you look at their holdings, what's also interesting is about 85% of the holdings among the top first percentile is mostly financial assets. So they're the ones really benefiting from all this inflows of capital or liquidity injection from central banks, as we've seen and deteriorated this inequality problem we've seen for some time. Now, I see some technical issues and perhaps a key macro event forthcoming in the following months, not too far away, in the next 12 months. Basically, about 70% of all the treasury that have been issued, in other words, all the way that the government has funded its recent amount of debt increase that we've seen has been through very short-term treasuries, and those are mostly through treasury bills. So we've seen in this red line, the outstanding amount of treasury bills have risen close to $5 trillion. We've never seen anything close to that. You can also see the year-over-year change in the white there. That is also unprecedented amount of issuance that we've seen so far. And what are the problems with that is that immediately we know that if those are treasury bills, about $5 trillion would have to be rolled in the next 12 months. Okay, well, if we know that, that's perhaps the reason why the Treasury here today in the U.S. is hoarding a lot of cash. So when you look at the cash balance of the Treasury here, we've seen a spike in that number, and I think it's related to this amount of short-term funding that we're seeing through Treasury bills. So the average maturity of U.S. Treasuries, if you look at across the entire public debt that we see of marketable and non-marketable securities, we've seen that this amount of average or the average maturity of U.S. Treasuries has been dropping significantly because of that. And so I think this is all kind of interesting, pointing, and if you include other tenors of the Treasury market, about $8.5 trillion of Treasuries will be maturing in the next 12 months. That's the key macro event that I want to talk about. The $8.5 trillion will have to be covered. Who is going to buy that? So let's look at that for a minute. There's a convergence, what I call a dangerous convergence happening in the markets today, in which when you look at Treasury holdings, and a lot of people are looking at this the wrong way in my view, they're looking at the overall public debt rather than only the marketable securities. Marketable securities are the ones that the foreign investors and the central banks are really participating. That's the one you should be looking at. That's the one that's being issued recently, and the one that you need someone to come in and be the buyer of last resort. So if you see on the red line, we've seen the percentage of ownership of foreign investors have been dropping significantly, regardless if it is the Chinese central bank or the Japanese central bank. All those large allocators have been reducing the amount of ownership of treasuries. At the same time, we've seen the Federal Reserve becoming more and more a part of this market. It's almost like a debt monetization scenario that we see that is also very positive for precious metals that we've seen throughout history. So then what's causing here is what we call the supercharge environment, is when the Federal Reserve is actually purchasing treasuries to drive interest rates lower as they expand the monetary base. And by suppressing interest rates, we see real yields going lower and lower and lower. And we've seen other investors saying, look, what's going to be the driver of precious metals if 10-year yields are already all-time lows? Folks, everyone is looking at the TIPS market. The TIPS market doesn't have a long history. You've got to go back to the 70s. To go back to the 70s, you have to look at nominal rates relative to headline CPI. And I understand headline CPI isn't necessarily the perfect indicator for inflation, but that's the way we have it right now. And when you look at that, you can see clearly here that we have long ways from gone here. We've got close to 4.5% to 5% or so of negative interest rates, 10-year yields, and back in the 70s. I think we're going to see something very similar to that in the next few years. I don't know if it's going to be caused by nominal rates falling significantly, which I don't think they're going to get to minus 4% or so. But what I think it's going to happen is that inflation expectation is going to start rising versus nominal rates, causing this ratio to decline. But the Federal Reserve has other issues. It's not only funding the U.S. government. It has created its own monster, in my view, and it needs hand-holding across all parts of the market. One of them would be this one, is the corporate debt has been surging recently, especially recently, while bond yields, corporate bond yields, are at near record lows. This conceptually makes absolutely no sense. But the reason for that is because of the easy money that we've seen throughout history that has created this divergence between the two. You can see clearly in this chart that those two lines used to go together. Well, if you lending money to someone that is extremely leveraged, you want higher interest rates. That makes sense. But because of the Federal Reserve being participating or willing to participate, it actually hasn't participated in a very significant way in this market as you would think. But just the willingness to do so has caused the market to go to those levels, along with the short-term rates that we've seen so far. There are other issues that we're seeing. We've seen commercial real estate also falling apart recently. And the Federal Reserve has been doing, which I think it's sort of a misallocation of assets in general. Instead of stimulating, if they will stimulate, stimulating the commercial assets part of the real estate, why are they buying 99% of their assets in the mortgage-backed security space, mostly on residential markets? Residential markets are booming. Are we trying to create another bubble here as well? So anyways, I think there's a lot of issues in terms of the strategy that we're using. There's another thing that is happening too, which is along with those problems that I said about the corporate market, is also when you look at commercial and industrial loans, they have been contracting recently versus money supply. So perhaps this injection of liquidity we've seen from Federal Reserve, it hasn't been so fluid. It goes back to the whole idea that we always talk about. The Federal Reserve has to continue to buy assets and pump up equity markets. Otherwise, the whole system is going to collapse. And by doing that, what it creates a very frenzy environment for especially gold and silver and miners. And I think that this is where the opportunity lies ahead. You can also see here that the mortgage credit availability, which is another way of looking at how credit is not so available, is actually been falling in the U.S. Recently. This is, I think it's a Mortgage Bankers Association that puts out this report on a monthly basis, down about 32% on a year-over-year basis. Includes a lot of things, especially interest rates. Even though interest rates are low, at record lows, mortgage rates are at record lows in the U.S., you're still having some issues with credit availability. And believe me, the market hasn't even started tightening yet. So that's my whole point. Let's go to the other part. So a lot of people looking at the federal balance sheet as a whole. And I think that the right way to look at is really the measurement of QE. And how do you look at that? You look at the amount of U.S. Treasury securities and mortgage-backed securities that the Federal Reserve has been purchasing recently. And it's actually been doing the least amount they've done, the second least amount for the whole year. So no kidding, we've had a sell-off in equity markets recently. Equity markets need the Federal Reserve to keep purchasing treasuries to suppress rates to justify the valuations we've seen in stocks overall here in the U.S. I think that's the takeaway. Here's another problem that we've seen since the break of the gold standard: government deficits. They've been going lower and lower and lower. I should say deficits relative to GDP. They've been going negative more and more, as you can see throughout the cycle since the break of the gold standard. Right now, we reach close to 15%. But what is the problem with all this? Well, there's another issue that comes along, is that the deficits in the U.S., they actually tend to follow very closely, not most of the measurements of unemployment that most people have been looking at, but it's actually the amount of people that have been claiming unemployment insurance benefits, which is the white line in this case. It's still rising. It's still close to 30 million. It's this left scale, as you can see. Close to 30 million Americans are still claiming unemployment. That means that the government is having to fund those folks that need the money for. And that's what impacts the deficits. As you can see, this inverse correlation between the two, with the red line showing the deficits. Now, the other issue that we're seeing as well is the Treasury balance. The Treasury balance in the U.S. is at near all-time lows too. So in other words, imports versus exports are actually rising, and it causes the trade balance to fall apart. And when you include the trade balance and you look at that, unfortunately, the current account, the trade balance is a huge part of the current account. And unfortunately, current account it doesn't get reported as often as a trade balance. but you can kind of have a pretty good idea of what's going to happen with the current account by looking at the trade balance, because they follow each other so closely throughout the years. When you include the current account and the government fiscal deficits that we're seeing, that's what's called the twin deficits, right? And that's the lowest that we've seen throughout history. Now let's talk about portfolio ideas by that. Well, number one, the twin deficits, if you look at that versus equities, you can kind of see that there is a pretty good correlation or inverse correlation between the two. It kind of makes sense. Well, the government tends to reach, very high deficits at extreme levels when we have recessions and so forth. So equity markets tends to follow that pattern. It's a pretty interesting chart. But what's even better than that is when you look at the twin deficits in an inverse basis versus gold to S&P 500 ratio. It's the whole idea of the premise that we've been talking about, which is buy gold and sell stocks. It's just simple to understand the thesis. But when you look at gold to S&P 500 ratio, it follows a twin deficit so close throughout the years. And you can see that 3 decades of data here. And in my view, that suggests is that the gold to S&P 500 ratio is probably going to surge. I don't know what's going to be, if it's going to be so much of the precious metal side or the equity markets are going to fall apart. But I see a spread trade here that I think will continue to work, and it has been working since 2018. And usually when that gets going, we see a pretty long-term trend of gold outperforming as the S&P 500 or equities overall. Now, this is not just a U.S. phenomenon. We're seeing this globally. So there's what I call the global synchronized debasement. So gold has been rising versus almost all fiat currencies in the world. And I think personally that what's going to happen is that we're going to see a continuation of this value destruction of fiat currencies, especially relative to gold. I still believe that the dollar is fundamentally stronger than any other currency out there, but I still think that gold is ultimately the asset that really protects you against what's happening in terms of monetary dilution and fiscal incompetence and so forth. When you look at gold adjusted for CPI, I enjoy looking at technicals, and it looks to me like the longest and largest cup and handle I've seen in my career. It looks like gold is poised to break out to the upside, and I think that's going to happen very soon here in the next months or so. We're going to see an even bigger move here for gold that should drive other things. You can also see gold relative on a year-over-year basis. The delta of movement on gold prices have been really interesting recently. It broke out in another technical chart. Those are my 2 technical charts I have. As you can see, breaking out. For me, this chart, what it looks like to me is that it really reminds me, or it doesn't remind me because I wasn't in that era, but it certainly reminds what happened exactly in the 70s, in the mid 70s and late 70s. You can see the large spike in which a lot of people are saying, well, look, gold already had a pretty big move, not relative to money supply, not relative to the monetary base. I mean, when we had the same issue that we had during the gold standard, it was so impactful when they decided to break that standard back then in 1971. In my view, this is just as impactful as it was recently when the Federal Reserve said that it's going to print money unlimitedly. And I think that that's the same issue. It's as impactful as it was before, and it's going to have an impact, especially in metal prices, in precious metals prices. Now let's look a little bit more on the miners, because if you think about if I'm saying that gold and silver will probably going to be rising, while miners look as attractive as it gets. And when I look at the capital structure, or I should say the capital spending cycle of this whole industry, it now gives me back again the idea the supply has been so constrained in this industry. In other words, miners are reluctant to spend capital. And you can see in this chart, usually gold prices tend to follow this idea that miners want to spend money when gold prices are rising. Not the case today. They went through a very severe bear market since 2011 peak of gold prices. And now recently, with gold prices now rising significantly, I think that's going to cause is that there's a mismatch of demand for precious metals versus supply. Now, let's look a little bit more at the fundamentals for gold and silver miners. You can see here, median free cash flow for the top 20 miners has been rising significantly. That's not only caused by a lack of spending in an industry overall. So CAPEX is being reduced, but also cash flow has been growing. And it's the largest free cash flow year-over-year change we've seen since 1996. So this is an incredible opportunity in our view, and it's the only owned industry that we see in the markets today that truly is growing, is having real fundamental growth in this market. And I think that's going to continue. Look at this chart as well. It's just comparing if the mining space, if the precious metals companies were an actual sector in the S&P 500, it would have the cleanest balance sheets of it all. We've been, like I said, we've been through a bear market in the mining space, and what we've seen so far is that companies have become more conservative. They have to be, they've been forced to not be issuing debt. They've been forced to not be diluting their capital. Look at this next chart, for instance. You can see the net equity issuance has actually been dropping recently, and you can see that it's pretty much at a record low there. It ticked up a little bit recently, but it's still at a near record lows in terms of equity dilution. And don't tell me that debt is increasing, because debt is not increasing, otherwise that wouldn't be the case here. Matter of fact, in the last quarter, miners paid off their debt, so they did not issue as much equities as you would think with gold prices hitting all-time highs. At the same time, they paid off their debt, and their free cash flow is also growing. So from a value investor perspective, which I'm more of a macro guy, but I like to overlay the two, this is as good as it gets. Let's just look at the gold to S&P 500 ratio again. You see the long-term picture. It looks to me like we're at the beginning. It's just basing out. There's so much to happen still in this market. The overall total market cap for Apple today, and obviously this changes along, but let's just call it about $2 trillion or so. The precious metals industry, just as of yesterday, I looked at it, was a little bit below 600 billion. That means one single company is worth 3.5 times the size of an entire precious metals industry. I don't know what to say about this. This is as asymmetric of a bet as it gets. I think it's the only industry that truly benefits from all that is happening today, because I think metal prices are going to go higher, and those companies are going to start really making money. Those margins are going to expand, and I think that they're not worth 3.5 times the value of one single company. I think there is a convergence here that will probably happen in the next 2 to 3 years. When the other way to look at that is just looking at today, miners represent close to 0.6%. 0.6% of the whole global equity market. 0.6%. That's the entire precious metals industry. It's nothing. Used to be a lot more in previous years or decades. We've seen also inflows. It's important to look at liquidity. Look at the trends in liquidity. If you look at the ETF for gold, we've seen that total assets for that has been rising relative to the assets for the SPY ETF, which is the famous ETF for the S&P 500. I think this is a trend that will likely continue. It goes back to the buy gold and sell stocks, or the gold to S&P 500 ratio. Same idea, but looking at inflows of assets here. Here's another interesting chart. When you look at gold relative to money supply, we looked at equities relative to money supply at the very beginning of the presentation. And what we saw was that is at a near record overvaluation throughout the last decades, as you can see. And this chart is quite the opposite. We're seeing a huge base since the 2011 bottom. And I think this is poised to go much higher. It's probably going to look a lot like the 70s in my view. And so I think we're at the very early stages of a bull market for gold, especially. Then when you look at silver, let's talk a little bit about silver quickly. This chart is interesting because it's actually a lot higher right now. It's not a 19. Well, it used to be a lot higher. Now we've seen a sell-off in silver that, in my view, is one of the best opportunities you can find in equity markets today. But you can see here is that during the late times of 08, the Federal Reserve printed close to $1.2 trillion in 3 or 4 months, as you can see on that chart. And then in the next 2 years or so, the silver price went actually parabolic. I think there is a very high probability of the same thing happening today. We've had double the amount that they did back in terms of money printing in the late parts of '08. And I think the silver is still absurdly undervalued relative to money supply, relative to equities, you name it. I think this is a huge opportunity if I think that gold prices are going to lead precious metals much higher. If you look at silver miners, recently, even with the pullback, they still have been outperforming Nasdaq. They've been outperforming tech stocks recently. I think that the silver miners, the gold miners will be the new growth stocks of the next few years. Why? Because there won't be much growth in other sectors and other industries. I'm sure other companies will do well, but I think overall this industry will be proven to be the new growth environment that we're going to see in equity markets. And then here it is, another great chart looking at silver relative to money supply. It's even worse than gold. This is for me, well, on days like that we had recently with silver declining, 20+% since its previous peak close to $30 an ounce recently. I mean, I think people that are too worried about this whole short-term movement haven't looked at this chart yet, at least. So I think this is the level of opportunities represented in this chart, and I think it will probably be moving a lot higher as we've seen throughout history in other periods. I like to look at precious metals relative to other assets. So just to finish here, I think that corporate bond yields, as you've seen, if you looked at corporate bond yields minus CPI, you can see clearly that in real terms, why would you be buying a corporate bond today when you know that those guys are extremely leveraged and you can buy anything else like gold, silver, or miners? So the whole idea of having $15 or plus trillion of negative yielding bonds across the globe, nominal bonds, and then you have also in real terms, if you look at corporate bonds, you have the same scenario. You can also see a similar way to see this would be with the S&P 500 earnings yield. And if you look at it in real terms, it's at a decade low. Every single time that happened in history, or at least that you can see in this chart, gold outperformed stocks for the next few years. Does it mean gold during those other times stocks fell apart? Yes. And the first one it did, and the second one it didn't. And the second one was right at the bottom of the equity market. But gold, precious metals, went up so much that it actually outperformed the S&P 500. So I think we're in a similar position at the same time as we have commodity prices at a record low. I think this is my last chart, but I wanted to emphasize my last thing is that let's pretend you went to Mars for the last 3 years or so, or let's say not 3 years, but last year or so. And I come back and you come back to Earth and I tell you, look, we have, close to $3 trillion of money printing. We took rates to zero and we took government deficits at levels that we only seen during the World War II. Do you think that policymakers would be ever trying to fight deflation in an environment like this? Well, that's what we're seeing today. And so I think this dovishness is not going to stop. It's probably going to continue, and it leads to higher precious metals prices at a time when miners are also at very low valuations. So I think this is setting up perfectly. This is a 2 to 3 year move that I think it's going to happen, and we'll see if I'm going to be right. But we're certainly positioned for a movement in which precious metals will lead the markets going forward here.
Wow, this has been
it's a lot of charts. I apologize.
Wow, no. Just quite the opposite. It was like, oh man, I want to keep listening this because it's kind of jaw dropping. It's like, there's a lot of talk, saying that okay, the market are gonna keep going. The markets, we see this tech mania that is coming up a lot. We see that. There are different trends that we can follow, but actually the miners, we say in Spain that if you want to go to the miners, you have to cry at home before coming in, So it's something that not a lot of people is able to say, okay, I understand what is going on here. But I see, in your funds, not only the one related with the miners, the precious metals fund that is, you are killing it there, man. It's 52% up to July. So this is incredible. But also the global macro hedge fund, the long short hedge fund up to above 30% profits. It's like, what the heck are you doing? I mean, this is kind of incredible, Tavi, and it's something that I want to understand. I know that you invest in these macro trends. Your bet is gold is one of your bets, but also you were shorting, if I'm not wrong, shorting stocks. I mean, there are many things at a time. You were also managing options. I mean, I'm talking in the general perspective, okay? So, what the hell do you do?
Well, it sounds like it's just me, but it's myself. We have a team, and the other head of making decisions here is also Kevin Smith, and we work very closely in terms of creating those macro trends. Kevin is much more of a value investor than a macro guy, and I think that creates a very interesting combination, having the two approaches blended together. I focus a lot on creating models and looking at charts and analyzing data to create a lot of macro trends. And then Kevin and I really discuss a lot deeper in their investment team to how can we really implement those ideas. It doesn't, we've been wrong about shorting equity markets for a while. The equity market's short. We've been net short the entire, you mentioned our performance so far, which has been really great. But we've been net short the entire year. It did really well during March, especially, or during the first quarter of the year. Those shorts paid off incredibly well. A lot of the precious metals miners were down somewhere close to 60-70% during that month, or during that corona crash that we had at the time, coronavirus crash that we had. So I think that it's, the whole spread trade idea sounds very appealing given this macro and fundamental story that we're seeing, and the lack of opportunities given how low rates are and how cheap money is, by truly inflating risky assets to a level where investors and large allocators are saying, look, we can't find yield here. We can't find returns for the next 2 to 3 years. Where are we going to find this? And I think that it's pretty clear that is in precious metals. Sure, precious metals had a big move recently, and a lot of people were a little worried about it. But here we have a pullback, and now people are saying that the story has changed. No, the macro thesis is intact. It's still the same thesis. I mean, the deficits are probably not going to get any better. We're not seeing a lot of improvements in that that amount of claims on insurance for unemployment. I don't think it's going to get any better. It's probably going to get worse. What if we have a change in elections? So there's so much risk involved with the equity markets that I think a lot of investors have been perhaps missing out, or not really taking a deeper look into the real fundamentals of all that. And what are we pricing? We're pricing a lot of assets to perfection. And I think that that's going to, again, make other people start thinking about, look, what are the alternatives? What can we do here? And I think gold will lead that market. You're not going to get rich buying gold. Gold is it's a large market. At its best, it probably can double. It's not going to. But silver and miners is where the real asymmetric opportunity is. We've been focusing even more on the exploration side of things, which is the very small guys, the guys that are worth 20, 30 million, not billions, million. So, our goal is to find those. There's a lack of discoveries across the globe, and no one wants to participate in the exploration part of the business. I think a lot of people worry saying this is a gambling business. It is gambling if you don't have the expertise to really navigate this market. We did a partnership with Quentin Henney, perhaps the best geologist, exploration geologist in the world, that discovered, along with other guys, the Kirkland Lake today, which is Foster View, which is one of the most prolific mines we've seen in the last few months, few years, or a decade or so. And I think we have a lot of opportunities to find other Foster Views in the holdings that we have currently. I think we've seen so far a lot of positions that have worked incredibly well. We just launched a new hedge fund to focus on precious metals mining stocks and do more of an activist stake. That fund was launched last month, was up about 80 or so percent net. And I think it's probably the largest monthly performance we've had in the history of the funds that go back since 1999. I think this is a real macro trend that, too many people are focused on the short term rather than seeing the big picture. And that's where the focus needs to be. And I think that's where allocation needs to be. And that's where we're going to be for the next few years.
Absolutely. I had a question regarding physical gold or mining companies, and I think it's clear. You know, mining companies is where we can find this asymmetrical, as per your opinion, this asymmetrical possibility, and I see it totally clear. I have another question, Tavi. That is, so there's a thing. I mean, we have many deflationary dynamics now, okay? But also I see that this big amount of debt could be, let's say, wiped out with, a ramping inflation. So what's your take on the inflation, and what is to be regarding this topic?
Look, it's such a fascinating topic because I think a lot of people have been focusing on inflation and deflation and missing the opportunity for gold, where I think gold works in both scenarios, in which if we do have a deflationary bust, we're going to see likely, especially Treasury bonds in general, move even lower in terms of yields. And I think that creates an even better opportunity for precious metals overall, as we've seen a lot of funds using the risk parity idea of having or pairing equities and bonds. And I think that a lot of that will be moving towards precious metals in the following years, which is a sector has been forgotten, or an asset class that has been forgotten for a long time. I think there's only one way out of this, which is monetary debasement. There is no way out of this in terms of the amount of debt that we've built since the gold standard break in 1971. I think that's, with a lot of people have been talking about this for some decades, but I think we've reached an inflection point where investors are truly looking for alternatives of the monetary system, and gold and silver certainly serve that purpose. I think it's probably going to continue for a lot longer. I think there's a very good discussion between inflationists versus deflationists recently, in which a lot of inflationists, in my view, missed the point, which is QE perhaps is not inflationary per se, in combination with other things perhaps, in which you were, as the Federal Reserve, purchasing securities and giving and purchasing securities from banks in exchange, the securities and crediting the banks for those securities. That money cannot be used, right? So in a way, that's not inflationary, but where the deflationists, I think, missed the point as well, is calling that not an injection of liquidity, because if I am, an institution and I own treasuries, and I know the Federal Reserve is buying treasury securities and driving yields lower and driving prices higher and driving financial asset prices higher, well, that's liquidity. I'm getting wealthier. And for me, that's just, that's also wrong. So I stay in the middle. I'm not calling inflation. I think inflation is the only way out. Long term, that's probably going to be the case. You don't have to be a mathematician to figure that out. It has to be. The question is when. And so I don't need really to make that call. I think gold works in both scenarios.
It's awesome. Okay, so I have a last, but has to be quick answer. That is, do you think that the monetary policy and that the debt that we see presently will change the optimal way to invest in the next decade? So all this thing is going to change the whole big picture, and we have to think differently to invest properly.
Yeah, I think that the efficiency of monetary policy is about to hit a wall, and it's been hitting a wall for some time now. We're probably going to be even on the fiscal side. Also, there's no way out of this in the fiscal side, which means we're going to have to be austerity measurements in which taxes are going to have to rise. And at some point, discretionary spending is going to have to be hit. And when you look at that chart that I showed with the deficits that have been decreasing over time, well, that has helped growth. I don't think that trend can continue much longer. We're reaching some absurd levels of debt in a lot of parts of the market. And I think that's going to be, the cost of all this is going to be growth. It's going to be tough in my view, for equities to do really well, when you ask the question about inflation versus deflation, the investor that has to be answering that question is the equity market investor. That guy has to justify those absurd multiples we're seeing. And if we do have yields moving higher, you can be sure that the markets don't belong to where they are today, equity markets. So I think that that's even a bigger question. There is no way around this. I think that the Federal Reserve is going to have to, it will be printing money until it can. And likely that's why I believe there is even a very high probability of a disconnect from precious metals to equity markets, which is not what we've seen so far. And a lot of people are saying, no, equity markets and precious metals are together. They move together. I don't know if I believe in that. I think that's not the case. I think that in the following years, what we're going to see is a disconnect between the two as the Federal Reserve is truly cornered into or painted into a corner.
Well, Tavi, thanks a lot. It's been a pleasure having you on in this event. I don't know. I think the audience is gonna, thanks you a lot. Also, this presentation, since it gives us another point of view and the possibility of understanding much better how to invest in this other unknown sector that many people, a lot of people, they don't know exactly how to get into this sector. But I think it's a very, very interesting sector, and it could help us to create portfolios with this conservative way by investing in this special sector. So thanks a lot, Tavi. It has been a great honor having you on, and we'll see each other in the roundtable, because there's a thing that we lack so far. So we will see each other then. Okay.
Sounds great. Thanks, Iván. Gracias.
Okay. Gracias a ti, Tavi. Ha sido un placer.
Placer, sí.
Bye.
Bye.